5 people, same year, same amount of money. 17 years later, they live in completely different worlds. This video is about why. January 2009. The financial crisis had just finished burning everything down. The S&P 500 had lost 57% of its value. Unemployment was climbing past 8%. Bear Stearns was gone. Lehman was gone. And 5 ordinary people with $10,000 each had to make a decision. Alex put his in a savings account. Sarah bought gold. David put a down payment on a rental property. Michael opened an index fund and reinvested every dividend. And Emma, in early 2012, when she first heard about Bitcoin on a forum, bought in at $5 per coin, a note on Bitcoin. In January 2009, Bitcoin existed, but it had no market price and no exchanges. The earliest realistic retail purchase was January 2012. That is the entry point we use. It remains extraordinary. We will follow all 5. We will not round up the numbers to make the story cleaner. We will not pretend it was obvious in advance who would win. This is not financial advice. This is forensic examination. Before we track what happened to their money, we need to understand a mechanism that was described almost 3 centuries ago. His core insight, written in 1730, was simple. The first receivers of new money benefit. The last receivers are harmed. His key observation: when new money enters an economy, it does not arrive everywhere at once. It arrives at the central bank, then flows to primary dealer banks, then into financial markets, stocks, bonds, real estate, and only later, sometimes much later, does it reach wages and consumer prices. Those first recipients, the banks, the institutions with access to credit markets, buy assets at yesterday's prices. By the time the money reaches wages, those asset prices have already moved up. Cantillon called this sequence almost 300 years ago. The data from 2009 to 2026 will confirm it. Let us start with the facts. The United States Federal Reserve tracks something called M2, the broadest measure of money in circulation. Cash, savings accounts, money market funds, everything in circulation. In January 1990, M2 was $3.17 trillion. By January 2009, the year our 5 investors made their decisions, it had grown to $8.29 trillion. That is a significant expansion over 19 years. The economy grew, population grew, credit expanded. This is normal. But then, March 2020. In 22 months, from March 2020 to January 2022, the Federal Reserve injected $5.6 trillion into the financial system. M2 went from $16 trillion to $21.65 trillion, a 35% expansion in under 2 years. For reference, it took 19 years to grow by $5.1 trillion. It took 22 months to eclipse that. By February 2026, M2 stood at $22.67 trillion. Total growth since 1990, 616%. Now, the question Cantillon would ask is not how much money was created. It is, where did it go first? Before we track what happened to their money, 3 things need to be clear. First, no one could have predicted which of these would win. Second, past performance of any asset tells you nothing about its future. Third, this is not financial advice. This is forensic examination of what happened. Throughout this video, each asset keeps the same color: cash in gray, gold in gold, real estate in orange, the S&P 500 in blue, Bitcoin in orange. The first 3 years look nearly identical. All 5 investments hold close. The differences are small. Alex's savings account earned 0.21% in 2009, the national FDIC average. His $10,000 becomes $10,021. Gold is already moving. Sarah bought at $8.55 per ounce. By end of 2009, gold closed at $1,097. Her 11.7 ounces are worth $12,800. The S&P 500 rebounds 26.46% in 2009, bouncing off its crisis lows. Michael's index fund, $12,600. 2012, Emma enters. She buys 2,000 Bitcoin at $5 each. At the end of 2012, Bitcoin closes at $13.50. Her 2,000 coins are worth $27,000. 2013. The divergence begins. The S&P 500 returns 32.4%. Michael's fund, 18,000. Gold drops 28%. Sarah's position falls from its peak to 14,000. Bitcoin goes from 1,350 to 775 in 1 year. Emma's 10,000 invested 12 months ago is now 155,000 on paper. She almost sells. Most people would have sold. The years between 2014 and 2019 teach a different lesson. Volatility is the price of return. Bitcoin collapses from 775 to 315 in 2014. Emma's position, 63,000. Then in 2017, it goes to 13,950 per coin. Her notional position, 28 million, then 83% in 2018. Gold recovers only partially. It closes 2018 below its 2011 peak, flat for 7 years. By end of 2019, the divergence is already stark. Alex's cash, 10,400. Gold, 17,800. Housing, 24,000. S&P 500, 35,600. Bitcoin, 14.3 million. Then 2020 happened, and everything accelerated. The S&P 500 crashes 34% in March 2020, then over the next 21 months, gains 116% from its low. Michael's index fund by end of 2021, 54,300. Bitcoin, from 7,150 to 28,950 in 2020, then 46,000 in 2021, then 75% in 2022. Through 2023, 2024, and 2025, the compounding continues. S&P 500 delivers 26, 25, and 18% in 3 consecutive years. Gold goes from 2,000 to over 4,000 in 2025. Bitcoin recovers through 42,000, then 96, then settles near 71,000. March 2020. In 1 month, the S&P 500 fell 34%. The Federal Reserve cut rates to 0 within weeks. It launched unlimited quantitative easing, buying treasury bonds, mortgage-backed securities, corporate bonds. In 3 months, its balance sheet doubled. Between March 2020 and June 2020 alone, 3 months, the Federal Reserve expanded its balance sheet by $3 trillion. The markets got the money first. S&P 500, March 2020 to January 2022, plus 116%. Real average hourly earnings for American workers, same period, plus 8%. January 2026, 17 years, let us count. Alex's savings account. Starting value, 10,000. Nominal ending value, 11,349. Cumulative inflation 2009 to 2025, 49.6%. Real purchasing power, 6,683, a loss of 33% in real terms, without a single news headline. Sarah, gold, $10,000 at $8.55 per ounce, 11.7 ounces. January 2026, gold at approximately 2,800. Value, 32,749. Return, plus 228%. David. Real estate tracking the S&P Case-Shiller National Home Price Index. Index went from 145.8 to 332.18. Value, 22,780, plus 128%. Note, this does not include rental income, leverage, or carrying costs. Michael. S&P 500 Index Fund dividends reinvested. No active trading. No market timing. Annual compound returns 2009 through 2025. Total return plus 948%. $10,000 became $104,755. And then there is Emma. 2,000 Bitcoin at $5 each, January 2012. Bitcoin price, April 2026, $70,747. Value, $141,494,000. That is a $141 million return from $10,000. Now pause. Before this becomes a Bitcoin advertisement, understand what Emma endured. In 2014, her position fell from 155,000 to 63,000. In 2018, from 28 million to 7.5 million. In 2022, from 92 million to 33 million. Almost no one held through all of that. Almost no one. The question this data raises is not, should you have bought Bitcoin? The question is, why did every single non-cash asset so dramatically outpace savings? The answer has almost nothing to do with the assets themselves. It has everything to do with what happened to money. The 5-person thought experiment has a real-world parallel. The Federal Reserve publishes quarterly data on the distribution of wealth across all U.S. households. The series is called the Distributional Financial Accounts. In 1990, the wealthiest 0.1% of Americans held $1.8 trillion. The bottom 50%, roughly 130 million people, held $0.73 trillion combined. By 2025, the top 0.1% held $24.89 trillion. The bottom 50% held $4.25 trillion. The top 0.1% grew their wealth by 1,285%. The bottom 50% grew by 480%. The ratio 2.7 times. This number comes directly from Federal Reserve data. Now watch the quantitative easing period. In 2020 and 2021, during the Federal Reserve's largest monetary expansion, the top 0.1% gained $7.61 trillion in net worth. The bottom 50% gained $1.76 trillion, partly from stimulus checks, enhanced unemployment, forbearance programs. The bottom 50% had a higher percentage gain. This is true, but they started from such a small base that the absolute dollar gap between them and the top grew dramatically in both years. Percentage can improve. Absolute gap can widen simultaneously. Let us step away from the abstract for a moment. Jessica is an ICU nurse in Houston. She worked through the entirety of the COVID pandemic. James manages a mid-size investment fund in Connecticut. In March 2020, Jessica's hospital was overwhelmed. She worked double shifts. Her savings account held $9,000. It earned approximately $18 in interest that year. Her stimulus check, $1,200, arrived on April 15th. That was 12 days after the Federal Reserve had already cut rates to zero and announced unlimited bond purchases on March 23rd. James understood the mechanical relationship between Fed purchases and asset prices. On March 23rd, the day of the announcement, he increased his equity positions by 30%. By December 2020, his fund was up 27%. Jessica and James both lived through 2020. The monetary expansion touched both of their lives. It did not touch them equally, and, crucially, it did not touch them at the same time. That gap between when money is created and when it reaches different people is the Cantillon Effect. It is not about greed. James is not a villain in this story. It is about the structure of how new money enters a system. The mechanism is not complicated. Central banks create new money, primarily through bond purchases, crediting reserves to commercial banks and primary dealers. Those institutions, before anyone else, now have access to cheaper capital. They buy financial assets, equities, bonds, real estate. From there, the path splits. For asset holders, prices have already risen. Wealth grows now. For wage earners, the money arrives slowly. When it does, prices have already moved. Cantillon described this sequence in 1730. The Federal Reserve data from 1990 to 2025 confirms it quantitatively. January 2026. 17 years for most of them, 14 for Emma. Alex, 11,349 nominal, 6,600 real. Sarah, 32,700. David, 22,700. Michael, 104,755. Emma, 141 million. This video does not tell you what to do with your money. It does not recommend any asset. What it shows is this. When new money enters the system, the sequence in which it arrives determines who benefits. The first recipients gain before inflation adjusts. The last recipients absorb the costs after prices have already risen. The system is not broken. It is working exactly as Cantillon described. Understanding the mechanism does not tell you how to respond, but it is very difficult to respond intelligently to something you do not know exists. 3 things the data shows clearly. 1. M2 money supply grew 616% since 1990. 2. The wealth gap ratio, top 0.1% versus bottom 50%, is 2.7 times, confirmed by Federal Reserve data. 3. Assets closest to the money creation source outperformed cash in every measured period. All data cited in this video comes from publicly available government and market sources. Links are in the description. This video is educational. It is not financial advice.